All right, there we go. Okay, welcome. Good to see everybody. It's January 25th, 2024. I'm Tim Quast. This is the live Edge demo and discussion. For me, in the upper left is Brian Wilson, who's our market strategist, and we're going to tag team this, as is we like to do this anyway. I try to cajole Brian into doing this as often as possible because he always adds a valuable perspective. So we're gonna get right into this, and I think I'm gonna go first, right, Brian? Is that our deal? Okay, so
yep, you got it.
Okay.
Age before beauty.
So I've got three core things that I want to cover. By the way, if you haven't done this before, there are just two rules. If you would just mute yourself while we're talking, and then two, please ask questions. I mean, there's no dumb question. Where everybody here is very respectful and congenial, and we want to try to help you make the best use of the platform that as you can. So with that, here are the things that I want to cover. I'll share my desktop. Bear with me a moment here. But I'm going to talk about monthly options expirations to begin. And for those of you, there we go. For those of you who are veterans, you might think, I really don't want to do this because I'm fully familiar. So I'll ask for your forbearance because I just think this is important stuff to understand about the market. So when I say monthly options expirations, there's a calendar. If you're new to Edge, you can go over here to how it works. This will take you to the landing page, the website. And under resources, you will see the 23 calendar. If you want to look back, the current calendar, even the 25 calendar. So I'm going to click on this. And the reason, it's not that I want to talk about the expirations calendar per se, but there you have it. We get this data from the Options Clearing Corp. The head of client services in Modern IR compiles this stuff. And then our branding firm puts it together like this, and we do this every year. So we go out and look for a variety of things, not just the options expirations dates, but also index reconstitutions and rebalances and so on. And if you go to the bottom of this, you will see the key there, all the things that we track. And it's really extraordinary. And of course, you could say, well, isn't this a form of confirmation bias? If you see this, and you look at what happens in the market, and you go, well, it seems to move with that. Maybe it is. Maybe it's coincidence, but I don't think that it is. And I'll talk briefly about this. If you go look at broad market sentiment, you will see these little green things on here, and you can. I don't think I can. Yeah, there we go. I can zoom in. Okay. So these denote the monthly expirations plus the month end. The reason that we do that, why not weeklies? Why don't we just crowd the calendar with every form of expiration? Well, because these are the ones that result in underlying asset changes. The weeklies may not. I mean, if you're gonna trade something for 3 or 4 days, why would you change and settle a position? There's cost associated with that. Maybe you would, but if you're the parties who traffic in those markets wholesale, that's not a good business strategy. And the monthlies are the ones that everybody uses for hedging. If you're hedging global risk from geopolitics or economics, if you're hedging currency or interest rate risk, and there are hundreds of trillions of dollars. You can look at the Bank for International Settlements. They publish all that data. You can see what stuff gets hedged and what kind of contracts exist out there. Well, there's an awful lot of that, and it tends to reset monthly. Now, what I don't know is whether the equity market is the tail or the dog. I don't know, but you can see this, right? Here's right ahead of options expirations, a bunch of moves. Even just looking at this period. In fact, the whole market turned. You could say, well, it's coincidental. But the day before month-end options expired, those are S&P instruments for the most part, but they're heavily used to hedge exposure to the equity market. They're heavily used to substitute for equity positions. Indexes use them, index funds. I'll just buy a basket of futures so long as it's less than 10% of the value of the portfolio. That doesn't take much because it could reflect a lot more value than that because they're proportional. That's where the term came. Again, you can say, well, maybe it was coincidental. Maybe it was. But just about everywhere that you see these squares, you see this is SPY. You will get volatility in line with those. Here, the market turned with month-end expirations, December 30. Here are the latest ones last week. What happened? The market shot up. Now, I don't know what's going to happen when the next green square comes, which will be next week, I think. But it's helpful to know. And when you're trading to go, if Forrest and I were talking about this, if you want to keep your gains, realize that these are things that may cause them to be eroded, may give you an opportunity. I mean, I don't know which way the market's going to move. Generally, if there's an extreme level, there's insufficient or excess supply, that is short volume, the market may move more dramatically. Why? Because there are counterparties. Look, I couldn't tell you. I would have looked at this and said, well, the market is sentiment bottoming into options expirations? Yes, it did. Demand stalled right there at, what was it, 4.6 or 7. What I'm looking at is the green part of the graph. I'll zoom it back out so we can see this. Right here, so it was 4.7 on January 12th, 4.6 on the 16th, and it stayed right there, right? It's been right there. And so then the market rose. That is often the case. If the demand side of the market is bottoming into options expirations, oftentimes the market rises with expirations. The weird thing is that the supply side was very high. But my core point here is that if you want to avoid risk, it's a good time to sit out. I very rarely trade single stocks during this period of time. I might trade the market directionally intraday based on that data. And it was very challenging this time. I had a hard time making money around options expirations this time around because of that. I would say, well, the demand's bottom. Should it go long? Should I do a leveraged long trade? I look at the supply and say, well, it's 51%. No, probably short it. But both directions were very difficult to do. But the core point is oftentimes, if you're going to have volatility, it's going to occur at monthly expirations. Why does that happen? Because there are underlying changes to assets. So there are stocks and there are rights to those stocks. And it could be futures or options. Indexes, ETFs have options and futures. You all know. So that all traces back to an asset. And if the contracts roll, what happens? Well, maybe an increase or decrease in the underlying asset. Am I going to continue to leverage to the same degree that I was? If I'm, let's say, Millennium, a huge hedge fund, and I've borrowed 8 or 9 times my underlying assets and I've leveraged them into options and futures. And I come to the reset and I look at the data and I say, what am I going to do? Right? Am I going to increase it, decrease it, roll it, abandon the trade? Right? All of that stuff's occurring. It's a lot of money. So you want to be aware of that around these periods of time. So I'll share doesn't mean that you have to do this or should, but what this leads into the next point. How do you play these things? Well, I mean, if you're very risk averse, avoid them. So if you don't want to have any risk, just close out your positions the day before and wait. You say, well, I missed out on this big move. You don't miss out. There's nothing, you're not going to miss out on anything. There is only the value of your portfolio and whether it increases or decreases, right? That's all that really matters. And so that's how I think about it. It's I have a thing that I'm trading and I want it to grow. That's it. And I want the probability of that outcome to be as high as possible. And it is not dependent on what the market does. It is dependent on the probability of the thing I'm trading increasing or decreasing in value. That's it. So that's then number two. If you say, well, I'm risk tolerant, I will trade it. Okay, well, here it's very difficult to trade single stocks. Now you can do it, but I find it to the odds, the probabilities diminish during options expiration. So I prefer during these times to trade leveraged directional ETFs, and I won't trade them for long. And Forrest, back to our conversation, if I have made my little bit, I traded SQQQ the last 2 days. It's a short trade on the triple Q, the NASDAQ 100. I'm not going to trade it long, but if I get 50 basis points, why 50 basis points? Because look at demand. I don't know which way that's going to go. Look at supply. Is this a pattern? It's come down 2 days. It's come down from 51% to 59 to 50.8%. It's statistically unchanged. Right? So I don't know which way the market's going to go. It's very unlikely to either hold gains or experience significant losses. I know that to be true, right? I also know this. If I go look at the data look at big tech. Basically, if you're betting directionally on the QQQ, you're betting for or against big tech. That's what you're doing. So I look at this and say, well, demand has peaked. And if I'm trading it yesterday, I say, well, and supply is above trend. So there's a slight convergence. I think that the counterparties who sold rights to big tech in December probably lost money. So they're probably going to be sellers of that. Now, I don't know that absolutely, right? I don't know it absolutely, but it's a pretty good hunch. So if big tech is up 50 basis points during the day, why that? Because it's half of SPY's volatility. And then if you lever it 3 times, so if I'm looking at, if I look at SQQQ and it's down, call it 2.8%, I think, well, I have a reasonable shot at getting a percent out of that because I know the facts. I am not gambling. I am stacking the probabilities in my favor. I know what the broad sentiment is. I know what just happened. The options expired and reset. I know counterparties have to square their books. I'm looking at big tech and I'm going, well, it's probably not going to rise a lot. Doesn't mean you don't have an outlier. AMD's, look, you can click through here and look at AMD. Forrest, to your point, how's AMD? Well, it's a 10 with 47, 48%. That's a really good trade. AMD is likely to do pretty well. Strong demand, insufficient supply. What does price tend to do? Rise. But as a group, I look at this and say, it's not awesome. It's, there's not a good theme there. So probably I could make a little bit of money, and I only trade those things for like 30 minutes, an hour. And it worked both times. I'm not suggesting that you do that, but I'm illustrating how I will use the data to help me. Final little point that I've got here is the intraday moves. How do you know what the market's going to do? You don't know. You do know the volatility. We could. I'm going to go back into big tech, and I'll show you how to do this. You could do this yourself. So you could pull this portfolio up, dump it into Excel, right? And you can run the volatility calc on this stuff really easily. Let's see. Here it is. And it's just, just to illustrate a point. Bear with me a second. It's slow when I'm running this video. So you could just go over here to the volatility column and just run an average on that, right? Here we are. So it averages, call it 3%, 2.5%. So that's how much stuff tends to move intraday. If something's down most of that, there's a probability that it will retrace some of that. If it's up most of that, there's a probability it might give some of it back. All of those things are true. It's not absolute. The supply-demand balance is crucial in that equation. It really is. But you have a pretty good idea of what things are going to do. Intraday, and again, this is not, it's not science, but it is facts about the way that the market works. That early in the day, high frequency traders are going to try to set the direction for the volume weighted average price, the VWAP, for all the stuff that has to happen at the end of the day. So these are important things to understand. So, and Brian Wilson probably could talk about this because he was a buy side trader for years. We have very good friends who are market structure experts and traders who tell us these things too. We'll say, well, early in the day, high frequency traders are going to change prices. How long does that last? Well, it tends to be about 11:30 Eastern time when that runs its course. Then you have the middle of the day where there isn't going to be there's poor liquidity. There aren't a lot of institutional orders in the market, difficult time. And then you have the last hour. Now, it's not perfect, but those things they're important things to understand about how the mechanics of the market work. In the last hour, that's where all the money that is trying to track get a reference price, a benchmark needs to be. And it tends to be where the big orders are. Everybody there is going to be scrapping for the midpoint. And so whatever direction the market's going to go, that's where it manifests. And look, it plays out pretty well. If the supply demand balance is about where it is now, we know it's difficult for the market to sustainably keep its gains. Gives you a chance for those intraday shorts. And you could go long too. If it retraces all of if it's up 50 basis points and it returns it to about 10 basis points, what's the probability that before the close, it's up 30 or 40 basis points? All other things being equal, very good. But it's not random. It has to do with supply and demand, the cadence and calendar of the market, and the mechanics, market structure. And so knowing those things will give you an advantage. Again, I'm not saying it's perfect, but during these times, I find it very difficult to trade. If it's there, we're going to share these things through the market desk notes. I find it very difficult to trade single stocks when there is no clear supply-demand divergence. And so this is what I'm sharing it because these are the things that I do. It works pretty well for me. I'll take those 50 basis points. I made 50 basis points yesterday and the day before. Works pretty well, but you have to be aware of what's going on around you. Okay, that's all. I think that's what Brian and I at the end will talk about what's ahead and we'll tag team that. So I will stop sharing and hand this over to you, Brian.
Sounds good. Thank you, Tim. Appreciate that. Good to see everyone today. Go ahead and share my screen. And I think what I'll start with today is actually a discussion that Tim did a really good job on this a couple of days ago in the market desk note. It's talking about the SPY. And it can get a little convoluted, and I'm actually going to take a little bit of time here during this discussion to actually talk about ETFs. But what I'm doing is I'm backing this look up for the SPY on a 1 year look. And we've talked about this the last couple of weeks, but you can see very clearly that this is an outlier right now. We have very low short volumes in the SPY. It really started towards the end of December, and it's continued here into January, trading just starting to creep a little bit higher here over the course of the last few days. And Tim was explaining this, how demand for the ETF itself, we think has really been part of the explanation for, why is the market shot higher right through here when demand in the broad market was a little bit stagnant and short volumes were high. We think behind the scenes, we just had some movement from an SPY perspective. In other words, just demand for the ETF itself. I did an exercise yesterday. I'll share part of this with you. It was part of my market structure note this morning. I just went to State Street. I downloaded the components for the SPY. You can see some of the percentages over here. I just went down to 50 basis points, which ends at Intel. And I think that was 31 names, if I remember right. So 31 names going down to Intel. That was 51% of the SPY, just those 31 names.
Wow.
You can see,
That's
Microsoft, 7%, Apple, 7%, NVIDIA that's been on fire, Amazon. What do all these things have in common? Well, big tech components, right? Over here on the left-hand side, you can see where we're at right now from an overall sector perspective. Here's our big tech components in information technology, communication services, about 9% of the SPY, consumer discretionary, about 11%. You add those up, that's about 50%. And now, obviously, we're just talking representative names from those sectors. But you get the idea why we talk about big tech, why you have it on your portfolio. What you're looking at here, 20-day and 5-day performance for all the sectors and sentiment as well. And I did a part of this exercise last week. I just wanted to show you if anything had changed. But look at what's happening for the market. There's the broad market sentiment over 20 days. There's short volumes. Where's the outliers? There's an outlier in healthcare, both from a demand perspective and a short volume perspective. What did healthcare do? It did well, 3.67%. A little bit of an outlier from a tech perspective, lower short volumes. Of course, we know big tech is part of that, 5% returns. Consumer discretionary, kind of out in front of their skis in terms of higher short volumes. The whole sector on a 20-day basis performed worse. Is anything changing right now when we look at this from a 5-day perspective? Well, sentiment has faded some, short volumes right around 51%. Look at utilities, right? Just awful right now. Demand awful, short volumes high, performance bad. Look at tech, above the average, really nice returns. And this is not an exact number with these big tech components. It is for sentiment and short volumes. This was something I grabbed in the middle of the day yesterday. But look at the 20-day performance for big tech. Look at the 5-day performance for big tech. It tells us that tech was to buy coming through options expirations itself. So SPY skewed heavily towards big tech. We see that in the components over here, those top 30, and you can see, Microsoft, Apple, NVIDIA, et cetera. And that was what I was discussing today with the under the hood discussion. Now, SPY itself, well, it's an ETF. I'm going to take you over to a slide deck. I'm not going to go through a lot of slides, but I wanted to share with you, what we're talking about. And sometimes a picture can really, paint an image that we can't do just from words itself. This is part of a discussion that's actually part of a class that we teach from an investor relations perspective. So this first slide here, in terms of ETFs, why do they exist? Well, the stock market has limited supply. Most shares are owned by investors who don't sell, but a lot of people want to invest in U.S. stocks. What do? We create a substitute for stocks, and then they can be increased or decreased in supply to trade instead of stocks. ETFs, one way you can think about that is collateral, and I'll explain that term here in just a second. This is actually how ETFs are created in the marketplace. Sponsor, think of it as BlackRock, lets authorized participants create shares in trade for collateral. So the broker is the authorized participant. It's an off-market block transaction. Tim, this might be dated, I don't know, but the broker pays $3,000. There's no commission for the fund sponsor. There's no taxes. The fund sponsor, think BlackRock in this case, gets collateral. That can be stocks or cash, and I'll show you some other things that it can be. And the broker gets ETF shares to sell in the marketplace. Here's another way to think about this. There's that ETF company authorizing the broker or authorized participants to create ETF shares. The broker provides, we mentioned Whitetree here in this fictitious example. The broker provides collateral to Whitetree.
We were cracking ourselves up at that one. Whitetree instead of BlackRock.
Right, exactly.
Yeah.
So, here's a very important component here. That collateral, let's say it's S&P 500, State Street. It doesn't have to be all 500 components of that. It can be, but it can be proportional shares. It can be a statistical sampling. It can be cash. Humorously, one of our salesmen was at a conference one time, and one of these ETF companies was there, and he was talking to him in the lobby, and he's like, "Hey, do you see that coffee cup over there? If we could make money off of that coffee cup, we would accept that as collateral." It just goes to the point that collateral can be many things. The ETF then trades on exchanges like a stock, and as you're aware, prices are then maintained throughout the day through the ETF arbitrage process. Got about 2 more slides here. I don't want to bore you here, but I think it helps to understand what's happening kind of behind the surface. What's the good here? Well, ETFs give investors exposure to the same stocks that other investors own. As you're aware, there's lower cost, there's better liquidity. The bad, ETFs themselves have no intrinsic value. They may be collateralized by stocks that someone else actually owns. We mentioned that term collateral. What are we talking about when we talk about that? Well, as I mentioned earlier, it can be a sampling of stocks. It can be borrowed stocks. And as we saw in the marketplace recently, I think this ties into what was happening. So think of State Street perhaps creating some additional shares in the marketplace for SPY, but maybe the ETF brokers couldn't find those shares in the market. So what were they doing? Perhaps they were borrowing some of those shares, and maybe that helps us to understand why short volumes across the market were rising at the same time the market was. Perhaps that was through borrowed stocks. Other collateral could be stocks owned by a single large investor, stocks owned by the ETF sponsor. It can be cash. And this is more to an IR audience. If you're part of an index, it doesn't mean that you might behave like the index. You can, but there's times where you will move outside of the index itself. So just wanted to share that discussion piece in regards to ETFs. If there's questions, about that topic, feel free to ping myself or Tim or Henry. We'll be happy to unpack those concepts for you.
Yeah, I would add, we verified all of that information. I think it took us the better part of 3 years to accumulate our understanding of how the ETF market works. I personally read hundreds of prospectuses to see if the same language shows up. And it's not just prospectuses. There are statements of additional information, the annual report, the semi-annual report. There's a lot of data. But to get to these things that we discovered, we had to read, to page 99 in a prospectus. It's in the middle of those things. Then we went around and talked to the ETF sponsors like BlackRock. I got to know a number of the people on the BlackRock ETF team pretty well, and I posed all of those questions. I said to them, okay, let me understand. I've read this in your prospectus, and I would read it and say, does that mean this? Does that mean you could take cash instead of the stocks? And they said, well, absolutely. We just over collateralize it. I said, well, could they write you a check that you don't cash? Right? I said, what if Morgan Stanley borrows the basket and supplies it to you? And they said, we take good collateral. That's Morgan Stanley's problem, not ours, right? It's Morgan Stanley who's short the stock, not us. We've got a product. And so we tell you these things so that you understand how the market works. That's really what it comes down to. What's driving the stock market? How do ETFs actually work? It's one of the basic principles of investing in anything, real estate, businesses, stocks, bonds, is understanding them, knowing how they work. And so we felt that this was very important for public companies. It's competition for investment in public companies. So it's tough for them. We look at the data and we see that investors are buying SPY instead of stocks. Why? Because it's very liquid. If I'm a hedge fund, I could go to Morgan Stanley and say, I've got $5 billion of stocks here, and I'd like to give those to you for SPY shares. And Morgan Stanley will create them and give them to the hedge fund, right? Now they got this very liquid instrument. They could short it, they could sell it, they could loan it, they could do all kinds of stuff with that. And they could say, here are the SPY shares back, I'll take my basket. That stuff is occurring. We confirmed it. And you say, well, what difference does that make to me? Well, that's why the supply-demand balance is so important. It's very important to understand which direction the market is going. And we can't see it perfectly, but we have a pretty good idea. Right? And so when we look at demand low and supply high, but they're not diverging from each other, what's the market likely to do? Exactly what you're seeing. Oh, that gives you a great confidence as a trader to know what's likely to happen. Okay, anyway. Steve, you look like you're poised to ask a question or make a statement of wisdom. We'll take that even more than a question.
Oh, I'm just watching what's going on in the bond field, and pretty concerned that what we see here is a Federal Reserve president who's wanting to take this to 5,000 for his legacy.
Who's to say, right? That's
what they're doing right now.
I do find it interesting in that vein, just anecdotally. You back up to Alan Greenspan was really the first person to publicly, speak to Congress. And they didn't hold press conferences. They didn't tell us anything, right? And then you get to during the financial crisis, Ben Bernanke was the first one to hold press conferences. He started holding press conferences. Jay Powell was the first one to hold a press conference with every single Fed meeting. Now we're watching inflation data, and now we're watching the bond auctions. I mean, if you were to put that on a timeline, you would say, boy, are we? It's as Mark Rowan, the CEO of Apollo, said, we are all leveraged to 5 growth stocks in the Fed. So you're absolutely right, and it's not a good thing. It's not a good thing when we are so focused on the government's finances, because that's really what it is. I agree with you on that regard. Yeah.
Regarding Dana's question, I while we were talking here and going through this, I flipped back and saw news. You got to watch and make sure that you're not getting your stock is not getting downgraded at the time you're buying it. It had 2 days before it had 2 downgrades. So that I look at that news. I use multi-structure edge, and then I go check the news before I go buy, and especially doing it when it's down a half or even more on its volatility. I want to know, is this falling because of a reason? If there's no reason, then I'm going to do the purchase on volatility. But
oh yeah, and I did the cardinal sin too. I was like, what, boy, if I liked it down 8%, I love it more down 10%.
Right. So Dana, something I'll always look at. I presume that you probably did. Okay, so you bought it here, right? Is that right? On the 19th.
Friday, yes.
Okay. Well, again, I would just point out that you never know, but I won't buy falling demand and rising supply. And notice this, that those bets, look at this, while this is relatively low, it's in the 40s, it's way off. So back here in January, it was all the way down to 40% short. So then here it's almost 50, right ahead of the news. Realize who is responding to these sell side upgrades and downgrades. By the way, the sell side has lost all of its influence with big institutions. So you say, well, they clearly seem to move the market. Well, that's who they're serving now. I got this straight from the horse's mouth. I asked the global head of equities at Franklin Templeton on a panel, at a big investor relations event that I was hosting moderating this panel. And I said to him, do you use the sell side? He said, we have no use for the sell side. We do our own research. I call sell side models the guidance for the proletariat. It's not what hedge funds are doing. I had the global head of equities from Point 72, the hedge fund for which the program Billions is predicated, on that panel too. Said, how about you? And he said, no use. We know way more than the sell side. So who's doing that? Speculators. I mean, that probably, and you could say, well, it's not fair. Well, I know it's not fair. It's probable that guy probably socialized what he was going to do, he or she, beforehand. And so then you see this big buildup, and right ahead of that, everybody was short, right? Then the downgrade comes out and everybody covers, right? So that's what's happened. All of this has gone away. And who did it benefit? Someone, because everybody's got a mortgage to pay. That guy doesn't have much value anymore, but he's going to serve a customer base. So if you see that before, always check, because you don't know what's coming, but somebody does. And so if you see a rise in short volume, it's at 10, but it's rising, don't fall for it. And if demand falls, the odds are against you. We have found statistically the probability of a bounce out of this is very low. It's less than 30%. Whereas using the Hicks rule right here, if it's 10 and supply falls, what's the price going to do? Almost axiomatically, it's going to rise. It will give you at least 2% in 1 to 5 days. We have found this to be true not over 90% of the time, all other things being equal. So that data will protect you. You see that?
Hey, Tim,
don't do it.
Does the data update at all during the day, or is it static?
It only updates
website,
once. Yeah, it's static, because how this works. Okay, I'll give you the whole, and we'll let you go. I've kept you along, but it's important. So the markets close 4 p.m. Eastern time. Then all that order flow has to be processed, and we trade 12 billion shares a day. The U.S. stock market does. It's a staggering amount, right? And all of that is going to be fed through clearinghouses, through the DTCC, the Depository Trust and Clearing Corp. The head of data there is a very good friend of mine. No, I've talked to him routinely, traded notes with him yesterday. So we know a lot about the food chain of the data. So then it's got to all get processed. And the SEC is trying to move everybody to T+1. Currently, it's T+2 for settlement, meaning you have a trade day +2 to clear all those trades and settle whoever traded ownership. And a lot of it doesn't even settle. But 3% of volume actually results in an ownership change using a loose number. Almost all of the volume is short. It's short-term trading. It's tied to derivatives. It's crazy, but true. Okay, so then this is how this feeds into our data. So at about 9 p.m. Mountain Time, we get the feeds from the exchanges who have now sorted. They're using models. They're just using an algorithm saying, we believe 99% of these trades will clear. There fails to deliver. It's an issue. We have big customers, corporate customers, who have to deal with this. I had this, I won't say the name, but a big broker dealer, and they said, there are times when we've had billion-dollar fails to deliver, and I have to go tell the CFO, you need to cover us, give us $1 billion to cover these. He said, that is not a fun conversation. So it's a tenuous thing. So then we apply so we consume that data, sort it, process it. We apply our algorithms to it. Our processes take an hour and a half, thereabouts. We pull FINRA data, exchange data, S&P data. We got all kinds of data feeds. So then all of that finishes about, call it 11 p.m. So then we post the data, and that happens. And so and it can hiccup. I mean, if there's a huge around options expirations, index rebalances could take longer because they're bursts, but that's how the process works for us.
That's 11 p.m. Mountain
That's
time.
Mountain time. Right. Yep. So usually by 11:30 p.m., if you refreshed your Edge platform, probably updated thereabouts. Yeah.
Thanks, Tim.
You betcha, Dana. Okay, we'll let you guys go. Here, I'll stop sharing this. We covered, sometimes you think, was that worthwhile? Well, we want you to be the most educated people in the markets about how the market works, because that's how we win. You know, we can't outcompete BlackRock and Citadel, but we can understand and we can go where they aren't, and we can feed off of them. That's what we're trying to do here, right? So it does work. All right, you guys, we'll see you next week. Thank you very much.